In my session today, I'm going to be looking at how we may utilize a trailing stop loss order. Very, very useful in any trading strategy. And to be honest, whatever duration. But I want to link it predominantly tonight through the dollar yen case study I'm going to do to trend trading and recognizing a trend and how we can use trailing stops to really help us gain the benefit of the whole trend. And one of the things that we do find with retail, whilst we enjoy our intraday trading, a lot of fun, maybe we do miss some of these bigger moves, which really can benefit our bottom line. And it still doesn't mean to say we can't trade intraday, but hopefully you'll see from the case study and you'll be able to visualize how these things can materialize and how we can really increase our positive risk ratio that we are trying to strive for or should be striving for in our trading. So straight away, just to get us on the same page, understanding a trend, well, it's a sequence of lower highs and lower lows for a downtrend, and the mirror image on an uptrend, it will be higher highs and higher lows. And what we see here is as the price comes down, finds support, when it bounces, it gets to a corrective high, it dips again, it finds a lower low, and then the bounce only moves up and it only retraces to a lower high. So we get this series of lower highs that we could effectively call a nice corrective high resistance. And it's that line in particular that we're going to use for our trailing stops. We can relate it clearly to our charts, and that's going to be very, very useful in the utilization of this order type. So why would we use them? Well, one of the key things is it can help us ride a market move. Far too often as human beings, we take our profit way too quickly. And then when the market continues to move in that direction, we struggle to get back on the move. And this order type is something that can help us stay on that trend. Often people say, the trend is your friend. And that's what we want to try and capture, the maximum P&L that we can gain out of any of these trends that we identify. The key thing that comes from that is as the trailing stop loss comes into play, we are protecting intrinsic value that sits in the trade. As in, the deeper the trade gets in the money for us, we don't want to lose all of that. We appreciate to confirm any bounce and retracement, we may have to give some back, but the idea is not to give it all back and certainly not to lose money off the back of a trade that we've been deep in the money on. And the other side of it is there is generally a negative stigma around stop losses and the utilization of stop losses. And given the nature of this stop loss, in most instances, if it works well, it becomes a stop profit. And hopefully that increases the positivity of using such an order type. Now, as I mentioned, we can use it over any time frame. You just have to adapt to the type of trading you're doing. It can be combined with other trading strategies, i.e. we just bring it in as an order type to help us plan and manage the trading strategy that we're in. You clearly need good chart analysis and, recognizing the important levels that we have in the marketplace that we're operating in. And once we get into these trends, they're very, very useful. And one other key thing, and something that lots of retail traders don't do, is adding leverage when we're in a position of strength. Once you identify a trend, it's much, much easier to add leverage as the market continues to move in your favor. And if you have trailing stops, that can also protect the leverage that you add into that trade as well. So let's dig a bit deeper. We're going to go straight into the dollar yen setup that I've got here. It's only the 20th to the 27th of July, so a pretty recent move. Basics of why we want to get into this trade. We're looking to short dollar yen, the rationale being the 10-year yields have been falling. There's always a very strong correlation between US dollar yields and the dollar yen FX trade. That positive correlation in this instance is US yields falling, the US dollar falls off the back of it against the Japanese yen. What do? We see the past price action. We see the 21st of July high at 138.87. We've got a subsequent lower high at 137.95 on the 22nd. And we got down to a base at 135.57. So we got some nice resistance levels up there that we can start off our stop loss protection level from. We've got the low there that we've now seen a bit of a rally, and that rally's gone up to a high of 137, which we could also see as a nice resistance level for our stop losses as well. And the 136.50, as we've got that rising trend line support there, could be the next trigger point. So for us, we're turning negative on dollar yen, and we actually probably want to trade of any subsequent break of that 136.50. But bear in mind, it's a rising trend line, so we've got to take that into consideration. We've also got the FOMC meeting at the 27th as well to take into consideration, and that could actually be the trigger of the downside move. So everything's in place. We roll the tape and bang, we get exactly that. From the FOMC meeting, we're able to sell the trigger of that 136.50 or the ascending support line. We managed to sell some units at 136.35. As traders, the first thing we should look at is how we protect ourselves. Again, that's our choice. We've got 137.40, 137.50, 138.10. And if we were traders that always wanted to give ourselves the most breathing room, we've got 138.87, but recognize that could be quite an expensive stop loss. And if you were to put it up there, you probably would need to reduce the ante or the size of position that you take when you instigate this short trade. So we've got our stop loss in play. We play it out now. We've got a nice little downtick, that first red candle straight off the FOMC. Yes, there's a potential profit there, but we've really instigated that down tick to get into the trade. So now we've got to let it breathe a little bit. We see the market stabilize where it's basically looking at what information has come to us, and then we see another sell-off, and quite a significant sell-off, 125 pips down to that 135.10 level. Now, myself as a trader, if I saw something as aggressive as that, I would always contemplate whether I should take some profit. And in this instance, as long as I've got enough risk in the marketplace, and that again relates to my confidence of the trade, I would not query anybody that were to take some of their position back at that low of 135.10. It's a decision time. It's an individual decision, a personal decision. In the instance of what we've seen here, the price action, the one thing I would err against, because things have gone quite nicely, is to just jump straight in and take your profit, because we want to let the market come to us. And knowing that we can use things such as trailing stops can help us protect what I've mentioned about the intrinsic value that we now have in this trade. So what can we do? Well, wherever we put our stops before, we can now trail that down. And in this instance, what do? You trail it down to an important level, that important level being a previous correction high. Now, we could be slightly more cautious and put it just above that trend line that we broke. And so that would be the previous high just by that FOMC decision notice that we've got up there. Again, one thing I would encourage is don't rush to bring these trailing stops down quickly after the first move, because these markets, and particularly the volatile markets that we have at the moment, have a tendency to retrace aggressively. And if you brought it down too quickly, you may well get taken out. And then again, that stigma of stop losses will come in. And it's probably because you're a bit too aggressive in bringing these stop losses down, these trailing stop losses too quickly. But nevertheless, in this instance, we brought it down to 136.50 and we play the tape as the market continues to move in our favor. And this, again, you can see some lovely red candles there where we've had an aggressive downtick. Again, you see a breathing space afterwards where the market takes into consideration what's just happened. Generally, I would use that to potentially take tranches back so that you're always capitalizing on these quick moves. But if you wanted to run the whole position, again, because you're confident of using these trailing stops, as you get down to that low at 132.50, you could already have brought down your trailing stop to 134.70. In this instance, because you've let the market breathe and the move is already on and the trend is now established, that's not too aggressive a move, because you're in this point where you're 385 ticks deep in the money, and you don't want to lose all that or a big percentage of it. So bringing those trailing stops down now to those previous highs is actually a smart move. And again, I will add, at any point, you can take your profit. For the instances of you visualizing what can happen and how much you can leverage this whole move if you show a bit of patience and use these smart trailing stops, hopefully it'll encourage you not to jump in and take your profit too quickly. As ever, when we're in a trade and we've still got some risk on, we're getting to levels and we're getting to points in time. So we may have a weekend review where we decide, do you know what, that's good enough for me. I'm going to take all my profit now. I've enjoyed that move down. I'm going to take a look on Monday. Or clearly you can keep taking percentages back, ride the rest, and keep utilizing smart trailing stops. If you've decided to cash in, what happens next? The Monday morning, you start taking a review, you see where the market lies. It may be that you actually feel the trend is still on. You've got the confidence of making lots of money. If you've completely cashed in, it's probably harder to sell down here, but the opportunity is still there. The most important thing you should be doing is looking forward at your calendar to see what is coming through that next week. It may encourage you to jump on that downtrend again. It may also err with caution, because you may see a piece of information that could come through that week that may potentially stop this trend or put a little bit more risk into the market, a bit of two-way risk. And therefore, you may actually decide you want to let those numbers play out, let that information play out before you get back into the market. That's all your own decision. That's individual. But hopefully you see from this showcase, by utilizing stop losses and trailing stop losses, you can maintain a nice short position in the trade. You can take profit, but you're always protecting the intrinsic value that sits in the trade. From this, your risk reward ratio will be massively positive. It'll give you a big boost to your bottom line. And hopefully it's something you can utilize going forward when you see other clear-cut trends like this.